Well, welcome everyone. Thank you all for joining in with us tonight. My name is Heather Frederick, and I'm the director for the Center for Arkansas Farms and Food, or CAFF for short. CAFF is a program at the University of Arkansas System Division of Agriculture, and we focus on strengthening our food system through farmer education, networking, and resources. Today, though, we're going to talk about farm taxes, specifically when you should start reporting your farming or ranching activities on your federal tax returns, and the types of records you're required to keep as part of meeting your federal income tax reporting requirements. This webinar is brought to us with support from the USDA Farm Services Agency Tax Education and Asset Protection Initiative as part of the American Recovery Act. It features materials developed by the University of Arkansas School of LLM program in the Agricultural and Food Law as part of the Agricultural Financial Tax and Asset Protection Initiative, or AG-FTAP, which is led by the University of Arkansas Southern Risk Management Education Center. And I think we've got a website with more information at that webpage for you that will be put into the chat box. Our instructors tonight, or this evening, are Poppy Davis and Winona Doris. Poppy is a business and policy advisor to agricultural and food and beverage enterprises, nonprofits, and local governments. She develops and delivers a variety of legal and financial education programs, supporting farmers, ranchers, fishers across the country, and teaches the agricultural taxation class for the University of Arkansas School of LLM. And formerly she was a California CPA. She holds a JD from Drake University Law School and a master's in journalism from Georgetown and a bachelor's in ag economics from the University of California, Davis. And Winona Doris, she is a business skills consultant and trainer working with farmers, ranchers, and fishers, small food enterprises, and related nonprofits. Winona develops and leads training on accounting, taxation, cash flow, insurance, and disaster planning and recovery for organizations around the country. She is a great-grandniece of Ed Scott, a Mississippi farmer who grew the family farm and became the nation's first black catfish farmer. The family lost and then recovered much of the farmland through the settlement of the Pigford class action lawsuit against the USDA. Through her family history, she understands the effects of injustices have on generations of people stripped of their livelihoods. Winona holds a bachelor's in accounting, a master's in business administration, and a graduate master's certificate in taxation. She's also a certified and registered tax preparer and a licensed insurance agent. So I'm really excited to hear from both of these accomplished women tonight. Just a couple of housekeeping items before we get going. We are recording this, and it'll be posted to YouTube, and everybody will get a follow-up email with a direct link to that YouTube, and along with some additional resources. Now, if you have questions as you're listening, please know that we have at least 15 minutes of Q&A time after each speaker. So if you can hold on to your questions until then, please do. But if it's like a clarifying question, just put it in the chat box, and Kelly and I will keep an eye on that and try and address that as quickly as we can. All right, now I'm going to pass it over to Poppy.
Thanks, Heather. I'm so glad to be here. So glad to be part of your program. I know you do really good work for beginning farmers in Arkansas, and I've come to love Arkansas in my travels there over the years. So I'm really glad to have this connection. Let's see, Heather, do you want to unpin yourself and maybe pin me? And then we can switch that over to pin Winona in a minute it's been a few minutes. I'm going to start out tonight with talking about the basic filing requirement. And we're going to get to a lot of things that are beyond filing through this discussion of when you're required to file. So for those of you that haven't yet started filing your farming or ranching business activity as business activity on your tax return, this is definitely for you. For those of you who have already started doing that and you think you understand your filing requirement, you're good with all that, don't tune out. because there is some stuff in the middle of this that is going to get to more advanced issues just through this lens of filing. So there's important stuff there about how farm tax losses affect your overall tax return. And then we'll do some Q&A like Heather said, and then Winona is going to do a deep dive on records. And I'll say the same thing just to cue her up. If you feel like all your records are in order and you've got great bookkeeping, first of all, congratulations, that's awesome. But don't feel like you won't get anything out of Winona's presentation, because what she's going to do is she goes through the record requirements, is she's going to go through all the important deductions and special things about them. So there is something in this for everybody, even though we're coming in at the most entry level. There's definitely stuff here for more advanced people that already have some of these systems in place. All right, that's my pitch for stick with us, and congratulations just for being here to tackle this hard stuff. I am now sharing my screen, and that is not the screen though. It is this one, view slideshow. Am I good? Yes. All right. So Heather already gave us the rundown on our funding for this. This is part of a 5-part, soon to be 6-part series. We're starting with lessons 1 and 2 tonight. You'll have to ask us back if you want more of the advanced material, but it is out there for you. And I believe Kelly's going to drop in the chat where the website is for you to find these other units if you are ready to get more of this on your own. All right, so this is important. It's requirements and recommendations. So we're going to talk about what's required, and we're going to talk about doing a little bit better than what's required. So let's get started. We're going to talk about types of taxes just to level set everything. A lot of times I find I'm deep into talking about federal income taxes, and then someone raises their hand and asks a question about state sales tax or state property tax. So we'll make sure we're all on the same page about what kind of taxes we're talking about. And then we'll get into the requirements, what the IRS says you must do. And then the recommendations is things that people miss a lot. And when they miss them, they actually do harm. People think if they can avoid the filing requirement, they're somehow getting away with not paying taxes they don't want to pay. But we're going to talk about ways that you're actually missing out on valuable deductions. And then we'll get into some of the special rules that make this whole thing work, and that will help you, particularly those of you who are beginning, who haven't started filing, or those of you who just started filing, but you don't really have a strategy around it. The last section will really help you understand how this filing requirement fits into the larger context of managing your business. All right, so taxes is a giant topic, giant topic. We're really just talking about federal income taxes. State income taxes, for the most part, follow federal law. All the state forms, even to the extent that state taxes are different from federal taxes, they start with the federal tax return, and then they tell you what to add or subtract to get to the state numbers. So you really can't understand state income tax without understanding federal tax. If you get your federal tax reporting correct, pretty much any tax preparer can get your state tax reporting correct for you based on that federal reporting. That's why we focus on federal income tax. These other types of taxes, county property tax, cannot emphasize enough how important that is. It's not just the real estate tax, it's the tax on equipment used in your business. But we're not going to talk about it tonight, but write it down if you're not aware that most counties do require you to file property tax return related to your business property, not the real estate, but the movable, the tractors and such. Sales tax, some of you may have that issue. Some of you may be super challenged by that issue. It may be like one of your #1 complaints, but we're not going to talk about it at all tonight. But do encourage you to find resources to get that straightened out, because it can really mess up your bookkeeping system. Estate and gift tax, that tends not to be an issue. That for the most part, currently, that's an issue for fairly large estates, fairly wealthy people. Payroll tax, again, cannot emphasize enough how important it is to get this right and not mess it up. And it can absolutely destroy your bookkeeping system. Winona can tell you that. but we're not going to talk about it other than to say, please do get help with payroll tax issues. If they're starting to confuse you and get out of hand, get on that quick. But no more of that tonight, no matter how nicely you ask. Okay, so on to federal income tax. So we're not talking about the general requirement to file an income tax return. You can easily look that up on the IRS website, the income level for if you have to file or not. W-2 income, file or not. Most of you would already encountered that at some point in your life. But this is about when you need to file your business activity. And you may feel that you have very small business activity, not enough to trigger a reporting requirement. But that's not the case. You have to report anytime you have self-employment income, you have to report it. It's different from a W-2. W-2, if it's very small, you wouldn't necessarily have to report. And then the key thing is just because you don't have to doesn't mean you shouldn't. You may have a refund. Your refund may be increased by a loss on your farm. We're going to talk about that more in a minute. The earned income credit may be very significant, especially when you're young families starting out in farming. The earned income credit can be a very significant income item. And when you understand how your taxes work a little bit better, you may understand a little bit better how to get the most earned income credit that you're entitled to. And that goes back again to understanding the value of business losses, which is what we're going to get to in this presentation. All right, there is a limited exemption for enrolled tribal members who have income derived from the land. This is a very specialized topic. They have additional wonderful resources at the University of Arkansas School of Law. If you are an enrolled tribal member, please do look into those resources. Everybody else, we're just going to keep moving, but I don't want to understate the importance of this for the people that it applies to. All right, so here's the basic requirement for self-employment income. Even if you're at a lower threshold than what the IRS generally requires for all income, self-employment income is different. And I'm going to keep saying that throughout this presentation, right? Self-employment income is different. So once you have self-employment income, you have to file a tax return if you have net earnings from self-employment income of $400 or more. That's a much lower number than the other filing requirements. But what I'm going to be talking to you about is the recommendation, which is if you have a smaller number than that 400 or even a negative number, a loss, you should still be filing, because filing that small number or that loss can really do you a lot more benefit. It gives you many more benefits than you may have thought of to file these tax returns sooner rather than later. All right, so this is to go forward, key terminology you have to understand. We're going to be talking about gross income and net income. Gross income is what comes in before any deductions are taken. So the definition of gross income is all income from whatever source derived. So all of it, that comes in. Then we'll have a different discussion about the deductions. Gross income minus deductions is net income. So if those two words aren't already clear in your head, just start memorizing them. It's only two short words. Gross is the beginning, net is the end. Everything else in between is what we're talking about. Basic filing due date, you all know this, it's April 15th. Some of you may have heard of a March 1st filing deadline. That's a special rule that only applies to farmers, ranchers, and fishers. It allows them to delay their quarterly estimated tax payments and instead pay all their taxes on March 1st and not have any penalty. So generally, if you have self-employment earnings during the year, you're supposed to pay in quarterly. But if you're a farmer, rancher, or fisher, you can pay it all on March 1st, but you have to file on March 1st and pay on March 1st. So some of you may well have gotten this March 1st deadline in your heads. You may well know farmers and ranchers that treat March 1st as their filing deadline. And now you know why. It's because they go all year without paying any taxes and they have to get it all in and filed, no extensions on March 1st. There's no extensions on that. So for some people, this is an important deadline. Not necessarily important for you if you don't choose to go that route. It's optional. You can choose to pay quarterly. And of course, if you don't owe anything, it's irrelevant. All right, so here's the real deal. The IRS cares about tax losses. So I'm gonna kind of show you what, oh my goodness, it worked. It's a miracle. Okay, so I'm gonna show you how the tax form looks. And you're gonna see where your farm loss would show up on your tax return. So this is the basic 1040. It's all your personal information, the dependents and such. Income, most of you have seen this, W-2, right? That's your regular paycheck that you've had before. Most of these other lines, still not things you care about. Now you get into, these are, most of these lines are specialized things. You know, if you have this kind of income, a lot of you young families starting out wouldn't have this kind of income. This is more for retirement income. Some of you are retired and also farming, so you already know what to do with these lines. This is where we're going to talk about farm and ranch income, okay? Additional income from Schedule 1, line 10. I'm going to take you over to that in just a second, but I also want to flag from you capital gain or loss. When you look at all your farm activity, it's going to actually come through on your tax return in two places. On the Schedule 1, I'm going to show you in a second, and also if you sell farm equipment, or if you sell animals that you use in your operation, like if you have breeding animals and then you sell them, that's going to come through on the Schedule D, just a little bit different from everything else. So let me take you over to the Schedule 1. This is another schedule with a bunch of rows we don't need to go into, okay? But what I want to focus us on is two lines here. The business income or loss attached Schedule C, and the farm income or loss attached Schedule F. So some of you have been self-employed before and using a Schedule C, you may be familiar with that. Schedule F is different for farm income. I just want to ask a question. We won't take time for you to unmute and answer it, but you can all think this through in your heads. There's like a gazillion different things you could do to make a living, and a gazillion minus one goes on Schedule C, and just one thing goes on Schedule F. What does that tell you? Farm and ranch taxes are different. They're so different that every other kind of business you could possibly be in fits on a Schedule C, and farm and ranch income gets its own form. Okay. Some of those differences are changing, but that's how it's been, and that's how it's going to stay. That Schedule F, a set aside, is really important. So if you're working with a tax preparer who hasn't filed a Schedule F for you in the past, or hasn't filed a Schedule F in the past, it's easy to direct them to resources so they can learn more about Schedule F, but it's important that you insist that you put your farm and ranch activity on the Schedule F, not C. All right, so whatever number that is, right, positive or negative, it goes back onto the first sheet here to factor into your total taxable income, right? Because the line 10 comes through, the Schedule 1 rather, comes through here. So any number on Schedule 1, positive or negative, is going to read through and increase or decrease your total taxable income. So if you have W-2 earning, let's just say $60,000 W-2, and you have a farm loss of $10,000, you're going to have a negative $10,000 coming through here. That's going to reduce your income by $10,000. And that'll translate through to a bigger refund. Bigger loss in this case is good. In the case of an earned income credit, you don't necessarily want to reduce your income. You may not want to see a larger loss. So we'll keep talking about when you would and wouldn't file. But I just want to make sure you all understand how a negative can help you, and that you don't want to just say, it's a loss, I don't have to file. That's not a deep enough analysis to really set yourself up for the best outcome. All right. So we talked a little bit about the earned income tax credit. So the earned income tax credit goes up as your earned income goes up. And then you hit a certain point And then the earned income tax credit starts to go down as your income continues to go up. So there's a sweet spot in there where you have a certain range of income that's maximizing the earned income tax credit. So you need to be aware of that and think about how you're tax planning. And Winona can talk a little bit about your record keeping. We'll talk a little bit more about deductions that you can sort of maximize or minimize when you're thinking about your goal, which may be to have a farm loss, it may be to have farm profit because you're trying to get credit. And it may be to pay attention to the earned income tax credit and make sure that you get the right amount for your family. All right, so this section here about assets and depreciation is where most of this key discussion focuses, because it's the assets that are going to make the real difference. If you have purchased farm assets and you're using them in your operation, then you want to report for sure, because you want to take the depreciation deduction on the assets. Now, you're required to show all your farm activity. You can't deliberately understate or overstate your activity. Winona will talk about that, but you can change the rate of your depreciation deduction. You can choose a method that maximizes it. You can choose a method that minimizes it. So if you want to show more loss, you choose a method that maximizes it. If you want to show less loss, you should choose a method that minimizes it. That's all legitimate, but you can't just ignore depreciation on your assets. And you shouldn't not file tax returns if you're already farming and already using equipment in farming. You should file the tax return and show the equipment as an asset, take the depreciation deduction. The critical thing is that when you later go to sell that asset, if you didn't treat it properly in the first place, when you sell that asset, you're going to have more taxable income because you didn't take the proper depreciation deduction. So it is important when anytime you have a purchase or sale of assets that you use in your business, that you put them on your tax returns and make sure that they're properly reported there, and that you're tracking the accumulated depreciation or the depreciation deductions and then the accumulated depreciation. You want to track that over time. And Winona will talk to you more about that in records. So there's a big last sort of constraint on all of this, which is none of this is if you're just doing it for fun. So I hear this a lot. Have you filed taxes? No, comma. And then some people will say, I'm still kind of figuring it out. I don't feel like I'm really in business yet. I'm kind of figuring out what I can grow. I can kind of figure out my markets. They don't maybe really understand that they probably are in business already. They're just not fully at scale. Another group of people says, no, comma, I'm a hobby, right? Or I'm a hobby farm. And half those people do not understand what the tax definition of hobby farm is. And maybe the other half are actually hobby farm. So that's what we're going to talk about now. In order to file tax returns as a business and take advantage of those things, you do need to actually be in the business of farming. And there are rules that help you understand if you're truly in the business of farming. So it's a facts and circumstances. You have to look at all the situation that you're in to understand if you're really farming yet. So I'm still figuring it out. We would need to have more of a conversation. What does that really mean? If you're truly just exploring and thinking about it, taking classes, that's great that you're doing that, but you're not in business yet. If you're just growing a little bit and selling a little bit, you're probably already in business. You're just not fully scaled because you have begun the activities that are directly related to generating a profit. So I'll give you another example. You start doing all your fall bed prep. You're not going to have crops actually produce that fall. The crops are actually going to produce sometime in the next year. But in the fall, you have absolutely begun activities that are directly related to the crop that you plan to grow and sell the next year. So you have begun farming with those fall activities. So again, when does it begin? When does the startup period end? You have to have done something that shows real effort towards some kind of sale and profit activity, but it doesn't have to be at scale. You can start small and grow into it. Is it a business? You have to be able also to demonstrate that you have a legitimate intent to profit. So if you're truly just making a few sales to friends because you really just want the tax deductions, that would be discovered. You have to be able to show more, a legitimate intent to profit. And that's going to be, I'll tell you right off the bat, you right now in this moment, take a picture of your computer, put it in your files with your tax records. You are doing something that shows intent to profit. You're showing up in the evening to take a business class on a pretty serious, unfun topic, right? That's more than just doing it for fun and giving the food to your neighbors and getting the feel goods, right? Everything you do that shows that you're treating your business like a business, good bookkeeping, good record keeping, taking classes, making changes to your operation to try again to do better. It's okay to fail. It's okay to get it wrong. It's okay to make mistakes year after year. What doesn't reflect well is if you keep doing the same thing and never making any changes. That's less an indicator of a real business than someone who keeps sort of guessing wrong, but they keep changing, they keep trying again until they hope to get it right. There's no requirement that you must be profitable to be a business. The requirement is that you must do the things that a reasonable person would do to attempt to generate a profit. You don't have to succeed. You are free to fail, but you got to try in a meaningful way. So they're going to, again, if the IRS looks at this, they want to see some sort of a plausible plan for generating income. And so where a lot of people will flunk out on this is I say, you know, what's your plan for marketing? And they say, oh, I'm just going to give all my, my plan is to give it all away to charity and to the school. I don't need the money. I just want to farm for my community. That is beautiful. That's great. It is not a plan for generating income. So it's not a business, right? If your plan is to sell it to the school into the school lunch program, that's a business plan, right? Donate to charity later, but you're going to sell your products to the school. You have a plausible plan for generating income. You have a kind of not very plausible plan. Like, I'm going to sell it all at a roadside stand, and there's exactly 2 cars a month that drive by my road, but I'm going to set up a roadside stand. That's a better answer than I don't plan to sell it at all. Like, I don't plan to sell it at all. You're just out. The next part is the ordinary necessary business records. Winona will tell you all about that. Take it seriously. That's the key thing. If you don't have that, it's like number one. If you don't have these 2 things, it doesn't really matter that you have the other things. Okay. In addition to these 2 things, the other kinds of things the IRS would look at is that you make changes to the operation and that you continue to come to classes like this to learn more. Many of you have heard this rule recited to you confidently by people who do not know what they're talking about and have misstated the rule to you. So I'm here to tell you what the rule is, which is if you lose money in 3 out of 5 years, you must be able to show evidence that you have a legitimate intent to profit. That's the whole rule. There is nothing in there that says if you lose money 3 out of 5 years, you are a hobby, right? It says if you lose money 3 out of 5 years, be prepared to show that you are not a hobby. You can lose money 5 out of 5 years or 10 out of 10 years. If you can show that at every point in time, you were operating your business with true intent to profit and doing all the things that a reasonable person would do, you're not a hobby. You're just not having a good run in your business and you are free to fail. All right. Okay, so we're ahead of schedule, so we definitely have time for questions. We don't want to go too over for questions. We're still going to probably keep this question section to about 15 minutes. So we got lots of time for Winona, and then we can have lots of time at the end for questions on both of these.
Happy there is a question in the chat box. We formed an LLC to put our nursery and tree farm in that leases the land, greenhouse, etc. from our corporation that's taxed as an S corp. Would it be better to put it under personal Schedule F instead?
No, I'm sorry. Thank you for that. So different entities. Let me reshare my screen here. I think I got distracted and didn't show you the other place that your farm income will show up. The other place your farm income is going to show up is where is it, Winona? Where's the Schedule E? CDE. I'm so old, I don't know the new form anymore. One. Here we go. It's on row 5 here of Schedule 1. So when you file that S corporation tax return, the tax return is going to generate a form K1. That K1 will come to you as an individual, and you report that income here on your individual tax return. So I thank you. I should have said that earlier. So this presentation has been from the perspective of where these deductions land on your personal tax return. But when you're filing a separate tax return for your business, it'll still flow through the business to you, the owner, and land on your personal tax return. But it flows through in a different way, flows through from the 1120S in the case of the S Corp. And I'll say too, for Winona's records presentation, so for those of you that have S Corps or partnerships, everything she's saying about records is still true. It's just that for you guys, it's going to be your corporate or your partnership records. And for those of you that are sole proprietorships, it'll be your sole proprietor records, but it's the same records requirements either way.
Can you hear me?
Did that answer that question?
Can you hear me?
Yeah.
So the farm is not under the S Corp. The farm is going to be under the LLC. So I'm filing an LLC. This is the first year for this, so I'm not sure. I'm filing the LLC for the farm, but it's actually leasing everything to our it's leasing everything from our S Corp. So I'm going to have 2 different filings. So my question is, do I even need that LLC, or should I put it on my personal return?
It sounds to me like someone who knew what they were doing helped you get set up correctly, and that you're set up exactly the way we want you to, but you don't fully understand all the details yet.
I'm an old account.
Yeah, no, I think you're set up correctly. I just want to help you understand why you're set up the way you are. And I want everyone else to hear this, because you've sort of jumped ahead to where I normally lead off for a more advanced class. So this is how we want you structured, and you are structured this way.
Okay.
The land itself should be owned by you as an individual, or perhaps through an LLC. Doesn't really matter to me, one way or the other. The land is owned in this way. The activities, the actions of farming and ranching, the running around, the doing, the planting, the harvesting, the selling, that goes in a separate entity. You keep those separate. The entity that has the actions is the entity that has the risk.
Yes, ma'am.
The entity that owns the land sits passively and cashes a rent check and does nothing else. Okay? If bad things happen because you're running around doing things, you want the full effect of those bad things to be stopped by the protection of that entity and not pass through to take the land and your personal assets. So that's why you want to keep the land separate from the farm, separate from the actions of farming, right? So in your case, the land is owned in the LLC, the actions are in the S Corp. Do the actions in the S Corp, file that S Corp tax return. The LLC, it's true for everybody. Everybody wants
the other way around.
It's the other way around.
It's the other way around.
The activity is in the LLC.
Okay. But is the land owned by you personally?
No, by the S Corp.
It's owned by the S.
You never, ever, ever, ever want to put land in an S Corp. Rule 1 of S Corps, never put land in. Try to get that undone.
It's
That was-
not, it's not okay, the paperwork is not the S Corp. It's owned by my husband and I, but
Perfect.
we have the payments and the liability and all
That
that.
can all be
going-
fixed. That can all be fixed. That's not a problem. The land is owned by you personally. That's what
Personally.
matters. Do not place
Yeah,
it in
we
the
want to
S corp.
separate it. Yeah.
Okay. So, the LLC does not need to file a separate tax return. That is an advanced topic. I don't want to get too deep into this, but the LLC itself gets to make a choice, and it gets to choose if it wants to be taxed as a partnership or an S corporation, or if it wants to just be ignored by the IRS. So if you choose to be ignored on your LLC, then you're as if it didn't exist for tax purposes. It still exists for state purposes for liability protection, but it doesn't exist in terms of reporting to the IRS. So you could report your farm activity on a Schedule F like a sole proprietor, even though you have the LLC. But I have to add one giant big caution here. It depends on if you're in a community property state, how you would do that. Because I'm gathering you're married here.
Yes, ma'am,
So-
Arkansas.
If you're married in a community property state, it's easy. You can choose to ignore the LLC and file as what's called a qualified marital joint venture, where you would each have an F, Schedule F on your return, and each be paying into Social Security and Medicare. Now, you may already be retired. You may be old enough you don't care. And that's fine. And congratulations. And so keep it simple. But I want younger people to hear this. If both spouses have not fully paid in to Social Security and Medicare, don't skip this step, because you're going to end up with one spouse underpaid, and that's not right. Okay. Now, if you don't live in a community property state, you don't have the option of the qualified marital joint venture. And then to do it correctly, you have to file a separate partnership tax return for the spouses, which is quite a bit more complicated. And I'd love to talk to you all day about this stuff, but I don't want to get too derailed. So maybe follow up with Heather for like a more advanced tax class. We'd be super happy to come back and do a deeper dive on this. Because I already see other questions popping up.
Yeah, there was a couple that kind of tagged on when you were talking about the flow of you know, how the S Corp and LLC. And someone asked, is that true for cattle and horse farming as well? And then somebody asked if, you know, what if the land is in a trust?
Yeah. So yeah, I do want to cover this because people clearly want to hear, and I don't want to leave you hanging here. So it's equally true for cattle operations as any other kind of operation. Like, it's always true. It doesn't matter what you're doing. You always want to separate the valuable asset from the risky activity. Whatever the valuable asset is, whatever the risky activity is, first move is separate those things, right? That's the whole point of why we have corporations. That's not a tax law concept. That's a basic business liability concept. Okay, and then the taxes just get in line behind that. So, and then someone asked about the trust. The trust is a little bit different animal, and I'd need to understand the nature of the trust to answer that correctly. So unfortunately, we just have to put that aside. You can absolutely have an LLC or an S corporation inside of a trust. You can do this stuff within a trust. But there could be all sorts of things going on behind that question that I can't guess what's really there. We formed an LLC to put our nursery and tree farm in
That's the
that.
one that was the one that we that was our
Okay.
first question up.
Okay.
Yeah.
Okay, so we're good. We're
Yeah.
good. Okay.
Yeah, but that next one though needs to be answered. Yeah.
Okay, good. But it didn't just say like that lease payment is super important, right? When you're doing it this way, it's very important that you actually pay the rent. Write the check or make the bank transfer, have it hit the other account, wait a day or two till it's cleared. And then if you need to transfer the money back, that's fine. Go ahead and do that. But make sure that rent actually gets paid, or else this whole thing is just fiction. All right. Business name has no, tax people do not care about names. That's a local business practices state law issue. When we are putting in our losses in the 1040, are we entering the gross? Oh, yeah. So on the 1040, it's on the Schedule F. Your gross income is at the top of the Schedule F, and then all the expenses are later on the Schedule F, and the last line of the Schedule F is your net, and that net number goes from the Schedule F over to the Schedule 1, over to the 1040. Did I get them all now?
And yes,
All right, that was a lot to just throw at you that was way off script. So, and we're still a little ahead of time. So I don't want to move on if anybody just suddenly got super blown away and needs something cleaned up.
Question on amortization of the equipment.
Yeah.
What's the typical for, let's say, tractors, side-by-sides, four-wheelers that are used in the
Either 7 or 10 years, and that's a choice.
Okay, but that's typical.
Well, also, I mean, typically you can, if you're profitable, you can expense them all in the first year. That's a special kind of expensing depreciation.
Okay, so
You have to know that
accelerated.
that's
Yeah,
right.
you've got to have an
know
accelerated.
you want that.
Okay.
Yeah. And then the
Okay.
7 years is a different accelerated method. And then the 10 years is a deliberately slowed down method. And there's
Right, but
lots of
that's-
reasons why people want to go slow.
Yeah, but the 10 years seems even long for some equipment.
Could be long,
as far
but
as
there's reasons
useful.
why, yep, there's reasons why you might want to choose long. This is the time to pitch the Pub 225, Farmer's Tax Guide, Winona's new favorite book.
Okay.
It has everything you need to know. If you're on this, if you haven't dropped off yet, then you too would like to read the Pub 225. It's very readable, really good information, very worth reading. There's lots and lots of good tips there.
Thank you.
There's a great question here. If I own the tractor before starting the business. Yeah, so this is a bookkeeping question. So Winona will get to this a little bit more, but what you're going to do is you're going to contribute the tractor to the business at its fair market value on the date that you contributed it to the business or put it in use in the business. So that's an example of where very typically someone was using their personal tractor for farming, but they didn't really carefully think through their strategy for filing tax returns. They kind of ignored that tractor. They didn't report the depreciation on the tractor on their tax returns for their farm because they didn't really know how to move the tractor from personal to farm. And they're missing out on that depreciation deduction for the tractor. But then when they go sell the tractor later, they're going to be taxed on the whole gain on that tractor as if it was a business tractor because they'd been using it in their business. So that's a great example of why you want to kind of get on this stuff early and file with everything sooner rather than later. I feel like we should, unless anybody's just dying with their head in a mess, let's get to Winona's presentation so we can cover this stuff and then we'll have more time for discussion again. So I think I'm done sharing and you can take it away, Winona.
Okay, sounds good. Let me share my screen here. Can everyone see that?
yep.
Awesome. All right. So in this second part, we're going to have a discussion around the record keeping requirements. This is just a note that this is part 2 of a 5-part series. Here, Poppy went over part 1. I'm going to do part 2 on record keeping. And specifically here, there's 6 sections to this presentation, and we're going to start out with the basic requirements for record keeping and then move into some of the special rules for businesses. And within that, the special rules for certain kinds of business transactions. And then we will end with a discussion of how long to keep the records and the financial record keeping methods and different practices, kind of go over like some tips to make this all really accessible and choose a method that actually really works for you. I think just as a precursor to this discussion, I want you to start thinking about realistically. I think, as I work with people in taxes and getting them to come in and put all of their record keeping together, the thing that we talk about most is what actually works for them. There are several ways to do this. You should pick the one that you're going to have the most success with. Because at the end of the day, we want the records, but don't try to force yourself to do something that's just not who you are. And there's no value judgment here. At the end of the day, we just need the records. So just keep that in mind as we go through this discussion around who you are, how you work, what is a realistic option. Okay. So first we'll talk about the general record requirements. So the IRS does require that you substantiate the income and expenses that you claim on your taxes. If you were to get audited, they will ask you for that. If you don't have records to substantiate your income and expenses, then you sort of leave it up to them to choose for you. And they are probably going to choose something that's maybe not the best position for you, right? But you really are putting your fate in someone else's hands when you don't have records. So it's always best to have records that cannot be disputed. So in most of this discussion today, we're going to focus on the requirements for the evidence related to business income and expenses, but there are other kinds of records that you might need, such as birth certificates or proof of residency and things like that to show that you are entitled to claim a particular filing status or take an exemption for a dependent. So just keep that in mind. So while we're talking about business income and expenses, this concept of record keeping applies to the entire tax filing. So on the scheduled 1040 Schedule 1, there are a number of items of income, including or loss from self-employment or rental income. You guys had a discussion around that, Schedule E, or participation in a partnership or an S Corp. So you do have to keep business records related to all items of income and expense for everything that is showing up on your Schedule 1. And how long do you have to keep them? Generally, 3 years after you file, right? So if we're in 2024, so now you count back 3 years. So anything 20 and before, you're all clear. You should be good to go, depending on whether or not you're under audit. If you're under audit, you have to keep the records. But if you haven't heard from them, you file your taxes, you can assume everything is good and you don't have to keep your records. I'm a little bit anal. I keep my records a little bit longer than that, but I'm not asking you to be me. So, but I just think it's a good idea to to kind of tell people you don't have to keep it forever. And plus now that everything is digital and on scan, it makes it even easier to keep records. But generally there is this 3-year rule. So the IRS is generally unconcerned about underreporting income, but they also will ask you and ask you to prove about situations where you may overreport income. So that begs the question, why would someone do that? Why would someone overreport their income? Maybe there's a program that someone qualified for, that maybe there was an income threshold that might give you an incentive to have to overreport income. So that might be one case in which someone may do that. So in order to substantiate your income, you're going to be looking at keeping checking and savings account statements, any sort of sales receipts and invoicing, and any sort of records that you keep in your business to substantiate that you made a sale and that you receive the monies for that, including records of any like bad debts or anything where like maybe you didn't get paid. So you even need record of that. The IRS, like I said, they're concerned about overstating. They're also concerned about overstating deductions. And you may be asked to prove that you have not underreported expenses. Your checking and savings accounts and your credit card statements can validate that you had an expense, and I think the bank statements are really good in that they will sometimes give you that description of what that expense was. Your credit card statements may do that. Those tend to be, in my opinion, not are always the best. I mean, they can be a little bit more general in nature. Really what we're looking at is, can you make the connection between that expense and your business, really? So that's when we start looking at, do you not have just a checking or a savings account statement, but do you have like an actual receipt that may detail what you purchase? So you, for example, you may go to a farm supply store and you buy bulk seeds and fertilizer. Well, it's kind of obvious if that store only sells, seed, right? Then there's no dispute that you bought seed, and why else would you buy seed? If you're a farmer, you're buying that for your business. But say you go down to your local super Walmart, I love a super Walmart, or a Target or something like that, where they sell any number of things. Some of the super Walmarts and stuff, they have paint and other kinds of supplies that you may use in your business, but they also have things that you buy personally. So here's where we need an actual receipt that shows what you purchased from that store and then how that expense relates to your business. So again, the purpose of the documentation and the receipt is to help you make the connection between that expense that you've put on your taxes and your business. In addition to the receipt, notes are very helpful. Right? It may not be immediately clear, or sometimes you may not remember. So when you have a receipt and you are putting that in your files in some way, sometimes it's a good idea to write a note on that receipt as part of the documentation. If you show to the IRS that you have a consistent habit of doing that, then they will happily, accept that as your record keeping methodology, and you won't be challenged on that if that's what you do. What business expenses can be deducted? You can and you must deduct ordinary, necessary, and reasonable expenses for your business. So ordinary expenses are defined as customary and usual. Does someone in this business customarily and usually purchase these kinds of things in this business? Is it normal, in a sense, to have this kind of expense for this business? So then that kind of checks the box on customary and usual. Common and frequent is also another criteria that you can look at. Do you commonly and frequently purchase this for your business? So then those kind of check the box around ordinary. Necessary, the definition is it appropriate and helpful for the development of your business that you have spent money on that item or that service? And reasonable, the definition is if it's reasonable if that amount would be paid in a transaction between two unrelated parties. So, if you were going to buy that from like just a stranger, that's like sort of the market price, that's the reasonable amount to pay for that. So those three things: ordinary, necessary, and then looking at a reasonable amount. And then your receipt is going to, your evidence, whether it's a written receipt or a computerized receipt or whatever record that you have. If they don't have a receipt system, it could be a note that you draft for yourself or from them, that they write a note. It could be a paper receipt. It could be something that you write up, date it, describe what you bought and what it was for, and that is your receipt. But what we're looking for is evidence that the transaction actually occurred, that it was for the amount that you're claiming, and that there was a business purpose. Okay, special requirements. So now let's get into assets. Okay, so now we already talked a little bit about this earlier in Poppy's section around depreciable assets. So for those that don't know, generally a depreciable asset is something that has lasting value, generally over a year. right, is considered an asset. Can you use that asset, and will that asset be used to contribute to you in your intent to earn a profit for over a year? If so, then we want to treat that item as an asset, and it goes on your balance sheet, so you don't expense them. If you expense it, that means you take it right to the P&L. I bought this, whatever you bought. I bought a piece of equipment. Maybe it's a piece of office equipment. I bought a computer to use in my business, and I just took it right to my P&L and I expensed it. Whereas if you depreciate it, then you know that, well, this computer, I'm really going to be able to use it for 3 years in my business. So I'm going to put it on my balance sheet, and I'm going to take depreciation expense. Depreciation expense is the way that you write off the cost of an asset in your business. But that cost is spread over the time period that you use the asset. There's another thing in the tax world, and I don't think we won't get into here. This is kind of an advanced concept, but I'll just kind of close the loop on this now. For tax purposes, there is a way to take the write-off of an asset all up front. It's under section 179. So I'm not going to get into that today, but in case you were thinking that, and maybe you heard of that, that is real and legal, and you should do that where you can. In those cases, for the most part, if you are depreciating for financial purposes in your accounting, then you may also be depreciating for tax purposes. But if you do the section 179 in the year that you buy a piece of equipment, then now your financial records for accounting and your tax records are different. And that's okay. So this is where you really have to dig into good record keeping and notes around what assets you've claimed where. So you need to know for tax purposes that you already claimed the full value of that asset in the year that you purchased it. This year you don't claim it again, because now you've double dipped. And that could cause some problems for you. Usually, if you're not doing your own taxes, if someone's helping you with your taxes, they will help you with this record keeping. The other thing is when you take that 179 deduction, you do have to list it in the tax return. So it's just you just being diligent and being careful to pay attention, that you go back, that you make sure that you know that you already took the full value for tax purposes. And there's some other tips that we can probably get into around that. In terms of, I'm going to bring up the section, the Pub 225. I do love that. And I love sharing that because it is very well written. So that publication, it takes all of the IRS sort of mumble jumble language that, the very trained person needs to understand, and it puts it in sort of everyday, simple language that anyone could understand. I literally could give it to my mother, who just learned how to text. I could give it to her and she could get through it. So I really highly recommend that you get that. The other thing that's in that Pub 225, there is a list of the typical assets in farming and the life that you would use to, the number of years, the depreciable period that you would depreciate those assets. So you don't even have to question, like someone asked about something earlier, was it 7 years or 10 years? Get publication 225. Go somewhere towards the middle of that guide. There is an asset listing or asset categories and the number of useful life years in that guide. You don't have to, it's kind of a thick guide, might be 70, 80 pages. You don't have to print that and waste your ink. You can order it. Go to irs.gov and they will mail it to you. Okay, so under animals, so breeding and working animals are assets and you depreciate those, but animals that you're holding for sale, they're not treated as assets, even though you may own them for a while. It may take a while, right, for you to be able to sell that animal. So that doesn't make it an asset. So specifically, examples of depreciable assets would be dairy cows, animals primarily kept for fiber, like sheep, roping horses, those are depreciable assets. For operations that are growing, like breeding herd and also growing like animal sales, it can be a little bit difficult to know which animal you're keeping for what purpose, and also the purpose of that animal may change, right? So this is a really specialized area of accounting that we're not going to dig into, but there are some resources out there. You can see some of the folks over in the extension programs around the country to help you set up a system to track this, if it is applicable for you to track the different animals and the purpose under which you're holding them. You should keep a detailed list of all of your assets. If you don't have a detailed list of your assets today, how do you know you don't have a list? Well, generally, I'm going to ask to look at your balance sheet and see if there are any assets listed on your balance sheet. There should be, right? If you look around your farm and you see all of this money that you've spent purchasing various pieces of equipment and things like that, you should see that sitting on your balance sheet. So that is supported with, your balance sheet assets are supported with an asset log. And on that log, you should have this information: a description of the asset, the purchase date or the date that you acquired it, the purchase amount or its value when you acquired it. Then you need another column saying what is take the publication 225, find out what the useful life is. That publication says it's a 5-year life. Now you know that you can do some simple math. If you do this in Excel, it makes it really easy. So now you know how much depreciation you should be taking by month, by quarter, by year. And then you're tracking that on this schedule in detail. So your balance sheet is going to have a summary of these assets. Your asset listing is going to be the detail of the listing of the assets. You also need documentation. So remember, if it's, if you purchased it, keep the receipt. If someone gifted it to you, then, your documentation on how you figured out the value of that asset. Maybe it was the value that they held in their hand when they transferred it to you, however you got it and however you can determine the value of that asset. We need evidence of that, and then put that value on your detailed asset listing. When you sell an asset, then that income is not a part of your business income. That's not if you're not in the business of buying and selling that asset, then that's not a part of your ordinary business income, and you could be generating capital gains income. Okay, capital gains income, it is taxed at a lower rate than self-employment income. So how do you figure out your capital gains income? You start with the price that you sold the asset for, less your basis. What is your basis? Your basis is either the purchase price, the cost that you paid for it, or the cost if you built it. If maybe it's an asset like a shed, maybe you built the shed. What did it cost you to build that shed? That's your basis. If someone gave it to you, that's your gift basis. So what is the value, the donor's basis when they gave it to you? What was it? What was their value when they gave it to you? That becomes your value. Or for inherited assets, you may have a stepped up basis. So you deduct the basis and the asset, and then you subtract from that the cost that you sold it for. And then that is how you figure out your capital gains income or loss. So the asset listing is really, really important, particularly if you know that you may be in a position to sell assets in the future. It's quite common to do that, but also it's important because on the balance sheet, it's important to be representing the value of the assets, because that helps tie into your equity section on your balance sheet, and which represents the value of the business per se, right? That at a very simple level. So please do your asset listing. If you don't have an asset listing, simple exercise, Take a pen and paper or a notebook, walk around your farm, start writing down what you see. And then go back to the office, dig in the files, look in your bank statements, look in your credit cards, and go and figure out, when did I get this and how much did I pay for it? If you can't figure that out, do an estimate of, I think I got it here at this time period, and you can sort of try to figure out what is the value at the time that you acquired it as an estimate and have proof of that. Or if it's a new asset, like go look up what it would cost me if I bought it today, just to give you an idea, a starting point. And from there, then you're set up to do your depreciation. And remember, the depreciation is how you move that cost that you paid to your income statement. But you're going to do that over the life of the asset. Travel, meals, and gifts. Okay. So for vehicles, there's a couple of different, different things going on with vehicles. So you could have a vehicle that exclusively is used on the farm, it stays on the farm, and it is owned by the business. In those cases, you should use the actual method of claiming the cost of that vehicle. So if it is a business-owned vehicle, used 100% by the business, then you can deduct 100% of all of the costs related to that vehicle. The purchase price, the maintenance, the fuel, everything, the repair, all of it, you can deduct. You need receipts to substantiate those items, those costs. Usually, if it's a mixed use vehicle, now we're talking about using the mileage method. The mixed use is it's your personal vehicle and you use it sometimes for business. For example, you take your car and you drive into town to go visit customers, to drop off samples, to go have meetings, to meet potential new clients, make new business arrangements, but you're in your personal car, in which case you now need to keep a mileage log. And the IRS absolutely will ask you for your log. What should be on the log? It should be your starting point and your ending point for that trip, where you were going and why. Then the starting point and the end point, and you take that mileage and you multiply that by the mileage rate that is set by the IRS each year. If you claim a significant amount of mileage, and I've seen this happen where people never claimed mileage before, and then suddenly they had a ton of mileage on their tax return, and it was legitimate, the IRS absolutely did ask them for the mileage log. So I recommend that you figure out a method for keeping a mileage log as you go, because it's a pretty painful exercise to recreate that, because minus the log to substantiate the use of your vehicle, they could disallow that and it could have dire consequences for you for tax purposes. Now, how do you keep a mileage log? Figure out the method that works for you. Remember, this definitely is a case of figuring out what will you do consistently to drive you towards success. For some people, I'm one of these persons. I keep my calendar. I have a smartphone. So everything is in my calendar. If I'm going somewhere, I write a note. I'm going to a meeting, I write a note in my calendar. And then I know that I can go back to my calendar and pull up that mileage because I kept it as a note in my calendar, in my phone. That works for me. They also have some apps that you can download if you have a smartphone. Most people do. They have apps that you can download on your phone where you jump in the car and you press the button and it starts tracking. And then when you finish the trip, you press the button, you turn it off, and then you can write a little note. They have that. Some of the software packages like QuickBooks, if you use QuickBooks Online, they have that QuickBooks app has a mileage tracker inside the app that does the same thing. There's lots of options, but just figuring out which one works for you. Just do something, whether it's shorthand, whatever you do, like shorthand notes somewhere in your calendar, in your phone, in a notebook. Just do something. Okay. You can deduct your travel expenses related to, purchasing of equipment and supplies and livestock and going to the vet and going to see your lawyer, going to see the accountant. If you're traveling because you're taking a class, like say you had traveled for this, we're virtual, but say this was meeting in person and you were traveling and you're doing this for the betterment of your business, the mileage related to travel to and from any sort of education workshops and conferences and things like that are deductible as business expenses. Okay, if you travel and you rent a car, then the cost of that rent for business, you're traveling for business and you rent a car, the full cost of renting that car for business is deductible as an expense on your tax return. You should have notes about what was the purpose of that trip, and that note should specifically demonstrate how that business trip relates to your business. And then the fuel and all of the costs related to the use of that car is deductible. Now, if you use that car, that rental car, even your own car, at any point on that trip for personal reasons, not at all related to the business, then that one specific portion of the trip is not deductible, and you should reduce your expense by that amount. So the record keeping in this area is significant. It can be daunting. I'm just going to be honest about that, but it is really, really, really important. Now, meals, the rules have changed a couple of times over the years, but currently for meals to be deductible on a business trip, you have to be away from your regular tax home for 8 hours or longer. Your tax home is the area in which you generally conduct your business activities, right? So the radius around your farm that you typically travel on a workday. So if you are out all day, traveling for business, doing business errands, those kinds of things, and you stop for lunch because you have to eat we want you to eat, then the price of that, the cost of that lunch, you can deduct. Someone went off mute, okay? There are rules, meals, so sometimes in your chart of accounts, you may have, I would expect to see at least at a minimum 50% meals and 100% meals, and there is a difference. Business meals, like for this travel, you get those at 100%. But the 50% meals, the entertainment related meals, those can be deducted at 50%. I think I'm saying that right. I may have gotten confused, but make sure that you look up the rules about which meals are deductible at 50%, which meals are deductible at 100%. And then when you capture those notes, put them in the right category. So for tax purposes, they end up in the right place. If you don't want to keep actual receipts, you also can do the per diem system, and you can use the GSA tables. There's a website. I don't know it offhand for the GSA website. You go to the website. It can be a little bit complicated, but maybe I've been using it for a while, so I'm kind of used to it. But on that website, it's really detailed, broken down by area. You put in the zip code of the area in which you're doing your business, and it will give you the standard meal rates that you can deduct. So if you do that, then you don't have to worry about the receipts if you do the per diem. But you still need the documentation about why you're taking that per diem. So you need some sort of notation around, I was in this area for this business related purpose, and my per diem that I'm deducting is this amount per the GSA tables. So you still need that. If you provide meals to your employees. So if you provide meals to your employees for your convenience, for example, if your crew working on the farm all day and you don't want them taking a long lunch break because maybe it's an hour into town to get something to eat, so you just provide meals for them for your convenience, not theirs, then you can deduct the cost of those meals with the 50% limitation. So if you are supplying meals on the farm to your crew, keep the receipts and the cost of those meals. In some cases, sometimes people are preparing those meals. So you go into the store and someone is grocery shopping and cooking those meals. So keep the receipts from the grocery shopping, including, I've seen people be pretty detailed about this. They even keep a price, the spices and everything related to that meal. Sometimes, I mean, we've gone pretty deep here over the years in having this discussion around, do I have to buy spices just for my house versus spices for my business? I'm not going to get into that. You figure out what is reasonable and that you can defend. That so that that you, I would say, don't cheat yourself, but do something that's reasonable, that you can substantiate the cost of the business meals that you may be preparing for your crew. For gifts, this one kind of hurt a little bit when they changed the rules. This used to be a very generous area, but now you are limited to business gifts up to $25 per recipient. You can give a gift that is more expensive, but for tax purposes, you can only deduct up to $25 per recipient for gifts. So usually you see this like end of year gifts for marketing purposes. You may, send all your clients basket, those baskets of muffins and fruit and all of that kind of stuff you send out. They make it a little bit tough because all that stuff generally costs more than $25, but unless you can sort of think it's kind of like position that as marketing. That's just an angle to think about for that. But if it's a gift, $25 per recipient, and you need receipts. Entertainment expenses are no longer deductible. I think that left us a couple of years ago. There are two important elements of ordinary necessary to be fully deductible that may look like entertainment, that's not. For example, if it is a promotional event for your customers, that's not really entertainment. It could be just an entertaining promotional event. Maybe you have people who are entertaining there, but it's really about promoting your business. It could be an event where you have entertainment at the event, or you have a dinner and you're using the produce that's grown on your farm at that dinner. That could kind of look like entertainment, but that's really you promoting your produce. Right, so that's fully deductible. If it's recreational or team building or appreciation events, those also may look like entertainment, but they kind of get the bypass there and you can deduct those. Again, record keeping here, I would say notation would be really important, because if you just look at a receipt, it could just look like entertainment and they could limit your deduction there. But having those notes about the purpose of the event, the attendees of that event, will really save you. All right, how long should you keep records? For generally, there is for general matters, the IRS has 3 years to audit you, so you should keep your records with, for at least 3 years. Again, as I started out by saying, I'm much more conservative. I keep my records for a very long time, especially now that it's just a little zip file on my drive. It's just a little PDF, so I keep my records for a long time. You may feel differently, which is totally fine. You can get rid of your records after the 3 years, or 2 years from the date in which you paid the taxes, whichever is later. If you've never filed, then the clock never started ticking. So it's not 3 years from the date that the tax return was due, it's from the date that you filed. So just keep that in mind. Keep employment records for 4 years, 7 years if you have a claim for bad debt, so records related to depreciable assets. As long as you have the asset, you should keep the records. When you finally dispose of the asset in whatever manner, then you can get rid of the records. So you can read through here and find the rest of the rules. Asset sales for 3 years. Records related to land, you should keep as long as you own the land and 7 years after the sale. If there has been a substantial understatement of your income, then the IRS has 6 years to audit you. So now we're into this other world where the IRS has questions in which case you definitely want to make sure that you have kept your records. Right? I think this is another reason why I started keeping my records a little bit longer, just in case, something came up. I want to be able to have the IRS have the official records. And again, without records, then it's sort of up to them, and they may not pick the most favorable conclusion for you. So some exceptions to record keeping, say there was a fire or some other disaster and they were lost due to circumstances beyond your control, then clearly you're not going to have the records, or maybe there was some sort of theft or something like that, then you may not have the records, in which case then you would go through that process of trying to substantiate the cost of things by what is sort of reasonable and customary during the time that expense was incurred, right? So it could be, going to look, and doing a search on the market for what it would have cost you or what it would cost you today as a starting point to recreate, those records if you have to. I talked a little bit about the methods of record keeping already, but you need to. The thing about record keeping, not only for your own management, but also should you be questioned if you have a method of record keeping that might look a little bit unorthodox, but that's your method, and you can prove that this is how I do it. That will go a long way with the IRS accepting that this is how they do it, and they have no reason to doubt that your information that you're providing is accurate, right? So that's the thing. This is where you have to decide, how are you going to do this? And then make sure you do that. And if you're working with other people, getting everybody on the same page so that if they're out and doing things for you and they need to come back with records, you got to get them, fold them all in, get them all on the same page so that you have a consistent manner of record keeping in your business. In your very first year of operation, and I don't know if some of you are in your first year of operation, you want to make sure that you go back and capture expenses that you've already incurred if you haven't done that. You want to also sort of develop a habit around sorting them into groups and categories so that you can put them in your tax, get ready for your tax return. This is sort of assuming that you don't have some accounting system where you already have some, kind of advanced practice going on. But usually beginning farmers kind of have this question around, how do I do this? There are a lot of people who are doing the shoebox method. There's a great envelope method, get some envelopes, and on the outside of the envelope, maybe you want to keep all of your receipts by month. Here's an envelope for the month. If that's all that you can do, then do that. Stuff all your envelopes in there for your receipts in that envelope for that month. If you can do a little bit more, maybe you have multiple envelopes and those envelopes have the category name on the outside. Maybe you have an envelope for automobile expenses. Maybe you have an envelope for seed or soil, or seed, or maybe you have another envelope for soil improvements, whatever are your categories, and you keep those. That is probably more helpful, because if you're keeping the envelopes by month, you still have to go through the exercise of sorting and categorizing, but at least you have them. But if you're sorting and categorizing as you go, it's time to do the taxes, then all you have to do is pull the envelopes out, pull those receipts out of that envelope for that category and add them up, write the total on the outside of the envelope, put the receipts back in the envelope, very important to keep them. And then you have something that you can show up to the tax preparer with. So just pick a method that you can stick with and get everybody else that's working with you who may intersect with this activity to do the same thing. So this envelope method, it can be a little bit tedious. Some of these methods can be slow. I always try to get people to do some sort of minimum level of bookkeeping some sort of minimum level, whether it's you're on the starter version of QuickBooks that's like $20 a month or something like that, and you're kind of rolling your receipts and your record keeping into there. But I think the point for me is do something.
Hey, Winona,
Yeah.
we've only got 5 minutes left.
Okay.
So I'm thinking maybe you could jump from here to the last section on how to get help filing your taxes.
Yes. I will do that. Okay. Okay. All right. How to file your taxes. They're going to get this presentation, right? So they can go through the other slides. Okay, great. Okay. So
And there's a recording available if they want to see the long version of it too.
okay, awesome. Okay. So options for preparing your taxes, you could use get the forms and fill them out using pen or paper, or use the online. You can go to the IRS website and they have the fillable PDFs. You could go to one of those Vita clinics and have one of the volunteers do that. In ag, I don't know if those folks have, in some areas have good ag experience. So that would be something to be cautious of, that they have the experience to do your return. You could use a tax preparation software. These are very good. TurboTax, H&R Block, Tax Act. There's a lot of them on the market. All of them pretty good, pretty easy question and answer format. So even if you don't know much, just going through the interview will get you the basis of a decent return. Or you can find a tax preparer to work with you to do your taxes. For tax preparers, there's a couple of options. There are enrolled agents, and they're also CPAs, and then between those two. So the difference between an enrolled agent is a person who is not a CPA, but who passed this test to get certified that they understand the tax code and can prepare your taxes. A CPA is a certified public accountant, someone who went to school, studied and got their degree and then passed the CPA exam. In terms of cost, the CPA is probably going to be more expensive than the EA, although that is changing a little bit. A lot of EAs are doing more complicated work. You see a growth in the market. There's a decline in the number of CPAs available and an increase in the number of EAs available. But in any case, those could cost you some money. You could also just walk into your local H&R Block office. I've never done that, but I hear mixed reviews on the cost and the quality of that work, but that is an option. Okay, I already talked about the CPAs, and we got to the end. There we go. Here is there's some resources at the back of this presentation that you can refer to get further information. That's it. I will stop share.
Great. Wonderful. Well, thank you. Poppy, I saw you were keeping up with questions in the chat room. Anything of note that you want to share with anybody who
No,
wasn't?
I mean, y'all missed the good part from Winona about the bookkeeping system. She wants you in for real. But I just didn't want to go over, and since we were tax focused, so just know that there is more good stuff on those videos that Kelly posted.
Yeah.
Winona and I both talked about different things today than's on those videos. So the videos are not going to be the same as what you got today. They'll be very similar, but really different as well. So
good. And we'll
Yeah.
follow up in an email with those recordings.
Yeah.
We'll send a link to this. And then Kelly just put in the chat room, there's an evaluation survey. So please, all of you, especially if you stuck through this, please fill that out, because it really helps us with these trainings.
And Heather, I mean, I don't know what you think, Winona, but I'd certainly be happy to come back. I mean, it seems like people are hungry for more. Winona and I are also super hungry to give this information some more. So
yeah, definitely. I'd love to have you both back with us. And we should figure out a way to do that. So
yeah, good. All right. It's been a pleasure. Thanks, everyone.
Thanks, everyone.
Thanks, everyone, and have a good night.
Bye.
Bye.